The stock market giveth, and the stock market taketh away. Although it's been a lot more taking away here in 2025. But what gives? Are we setting up for a nice sized bounce, or is there further downside? That's the question going through all investors' minds right now. And with all of this selling pressure, we have a slew of new stocks trading at fresh 52-week lows. As such, in today's video, we're going to take a look at 5 popular companies that are trading at or near their 52-week lows and decide whether they are a buy, sell, or hold. So make sure you stay tuned throughout the entirety of today's video so you can check out each of these 5 companies. And before you unveil them though, do me a huge favor. Show your appreciation by simply clicking that like button down below. Subscribe to the channel and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And when it comes to investing right now, there has been a slew of investors that have been pulling their money out of the stock market. And banks are actually turning cold on equities. So what are a lot of professional investors doing right now? Well, a slice of their strategies, they're turning to alternative assets or real assets like blue chip art. So even with the trade war intensifying, we just saw an art auction in Paris where there were some record-breaking numbers. This supports the historical finding that for the past 30 years, this asset class has shown a near zero correlation to other popular asset classes like stocks. And the market is already powered by the richest people in the world. In fact, Bank of America did a survey last year that said by 2026, ultra high net worth individuals could be devoting approximately 11% of their portfolio to fine art and collectibles. Luckily, diversifying your own portfolio no longer takes billions of dollars. You can do all of this through Masterworks' art investing platform, which also happens to be today's sponsor. Masterworks already has over $1 billion of invested capital from nearly 70,000 active investors. Each of Masterworks' 23 exits have been profitable, distributing back over $60 million to investors, including principal. Keep in mind again, these are investors that don't need millions or special connections. I'm not yet an investor right now, but Masterworks has over 450 art offerings that you could get involved in. In fact, some of the popular offerings tend to sell out rather quickly. So if you're interested in getting involved with Masterworks, I can get you to the front of the line by simply using the QR code on your screen right now, or you can check out the link down in the description below. All right, let's jump back into our video, taking a look at 5 stocks trading at fresh 52-week lows to determine whether they are a buy or not. Beginning with stock number 1, which is going to be United Health Group, stock ticker UNH. And when it comes to UNH, they have been through the ringer the past few months. They had the tragic killing of their insurance CEO, Brian Thompson. And then on top of that, they've had pressure from both sides of the aisles talking about higher medical costs. And when you have higher medical costs, this is going to not only weigh on margins, but ultimately weigh on earnings. The company currently has a market cap of $389 billion, a market cap that was once much higher. As over the past 12 months, shares are down 13%, and UNH shares have fallen 31% from their most recent 52-week highs. Shares are trading at levels last seen in 2021. For years, investors have looked to UNH as a compounder of wealth, a consistent, reliable company, share price appreciation, plus a strong growing dividend. But things have cracked of late. The company still yields a dividend of 1.9%, to go with a 5-year dividend growth rate of 14% and 15 consecutive years of dividend growth. Given the fall off from the stock, here's a fresh look at current valuation, where shares trade at just 15.3 times, well below their 5-year average of 19.6 times. And as you can see on this chart, the forward PE for UNH does not move all that much, between roughly 18 and 21 for much of the past few years, but here we are sitting at a 15 times multiple. Although costs are certainly going up, and this is undoubtedly going to weigh on margins and earnings, it's also going to allow the company to reset, increase its rates to help offset these growing medical charges. And that, in the longer term, will bode well for both the company and investors. So right now, if you don't have any exposure to UNH, could be a decent spot to dip your toes in. The valuation makes sense, solid balance sheet. So I would rate United Health as a moderate buy. And that leads us to stock number 2, which is going to be Alphabet, stock ticker GOOGL. And when it comes to both Alphabet and United Health, a lot of their pressures have been outside of tariffs, where a lot of pressures across the stock market are tariff related. Some related to both of these companies, but the majority has been elsewhere. With Alphabet, it's the DOJ case that's coming about, looking to break up the company and force the sale of Google Chrome. It's rather interesting because there came a time when people looked at Alphabet with all of the boom in AI saying, well, that's going to fade their search business. Now fast forward to where we're at today, and all of a sudden AI is going to help them dominate the search business even more than they already do. At least that's according to the DOJ. The company thinks that is far-fetched, and right now the company trades at a market cap of $1.8 trillion. Over the past 12 months, shares are down 5%, but they have fallen nearly 30% from their most recent highs. In my opinion, Alphabet is far and away the best value of all of the Mag 7 stocks right now. And you know my love and appreciation for Amazon, which again is also trading at a great valuation, but not as low as Alphabet. Alphabet is priced right now as if it's going to grow in the mid to high single digits, which I believe they're going to far outweigh that. That doesn't mean there's no risks out there, because we already talked about some of the risks with the DOJ case that's going on. So there's plenty of risks out there, but I believe a lot of it is already priced into the stock. So let's have a look at valuation just to see how low it really is. The stock currently trades with a forward PE of just 17 times flat. That's well below their 5-year average of 22.5 times. They also trade at an EV to EBITDA of just 13.6, well below their 5-year average of 17.2. The current EV to EBITDA has only been lower one time in the stock's history. Again, the current DOJ case is certainly not positive news for the stock, so that is some of the risks that we've talked about. But if the company does in fact have to break up a little bit, it could unlock huge amounts of shareholder value. And I'm a big believer in this company long term. They're a well-diversified company, not just with search, but they have the AI capabilities. They have YouTube, which is continuing to grow and actually a threat to Netflix share dominance there. So right now, based on these extremely low valuations, I rate shares of Alphabet as a buy. And that leads us to stock number 3, which is going to be Novo Nordisk, stock ticker NVO. And talking about a stock that's gone through the ringer, it's definitely been Novo Nordisk of late. However, if you look out over the past 5 years, this is still a stock that's up over 80%. The company currently has a market cap of $196 billion. However, over the past 12 months, shares are down 53%, and they are down over 60% from their recent highs. Novo has been not only one of the first movers, but one of the leaders within the GLP-1 weight loss space. However, there's clearly a big gap between the likes of an Eli Lilly and then down to Novo. And when it comes to my portfolio, I own Eli Lilly. And if you're interested in seeing my entire portfolio, then consider becoming an Edge Plus subscriber, where you get to see all of the stocks that I'm buying and selling and access to our monthly members only meeting. You can check out the link down in the description below. Last week, it was reported that Eli Lilly had its oral GLP-1 drug succeed in phase 3 trials, which sent shares of Lilly soaring and shares of Novo and other competitors falling as the gap widens between the drug companies. There's clearly room for more than one company to distribute these GLP-1 drugs. However, the gap is widening between Novo and Eli Lilly. And when we look at valuation, shares of Novo are definitely priced as if they're getting dominated, as the current forward PE sits at 13.9 times, well below their 5-year average of 21.1 times. EV to EBITDA sits at 15.1, well below the company's 5-year average of 23.9 times. Again, the stock is priced at this doom and gloom type situation. They are the clear second. There's a wide gap between Eli Lilly and Novo, but again, you can find stocks that are pricing a lot of this information in. And when you look at valuation, you see a PE that's at record lows, an EV to EBITDA that has only in fact been lower one other time in the company's history. So given all of that, Although right now I own Eli Lilly and I continue to want to put more money to work there, I'm going to rate shares of Novo as a hold. And that leads us to stock number 4, which is going to be Nike, stock ticker NKE. So a few of the first stocks that we talked about, we discussed that there wasn't as much tariff pressure as the reason on why the stocks are down. When it comes to Nike though, a big reason on why the stock is down has to do with their results, but more importantly also has to do with the tariffs. Because when it comes to Nike, they have a big international presence, particularly in China. If you go back just 5 years, total sales in China amounted to roughly 20%. Fast forward to today, although that exposure rate is coming down, they still have roughly 15% of total sales coming from mainland China. I'd have to imagine that this growing trade war between the US and China is going to have a lot of Chinese consumers turning away from many different US companies, particularly Nike. The company currently has a market cap of $83 billion, and over the past 12 months, shares are down 40%, which is roughly right around how far they've fallen off their recent highs, which is closer to 45%. When a stock is down big, I hear it all the time with clients that I work with. I just want it to get back to even so that I can cut bait. Well, sometimes it makes a lot more sense to cut bait even when you're down, because you probably said that when you were down 10%. Then you said that when you were down 20%. Lo and behold, now your investment a year ago is now down more than 40%. What you have to ask yourself is, as an investor, is the fact is, does your thesis still make sense? The reason on why you invested in the stock, does it still make sense? And the other thing, could the money that's invested in this particular stock be better put to work in another company that you have greater conviction in? This again does not mean that Nike won't recover, but you could find a company that could recover faster. The valuation makes sense. The balance sheet looks better, whatever the case may be. Looking at valuation, this is a stock that's certainly cheap, but one that I believe is cheap for a reason. As the company has not only come across intense competition over the years, but innovation has been lackluster. Right now, the forward PE sits at 26.4 times, well below their 5-year average of 31.4 times. The EV to EBITDA is roughly half of what the 5-year average is. EV to EBITDA sits at 14 flat, 5-year average is 24.9. So at first glance, the valuation looks somewhat intriguing. But what if I told you, looking back just 5 years ago, they had operating margins of 15.6%. Today, they're sitting at 10.3%. EBITDA margins 5 years ago were at 17.3%. Today, they're at 12.5%. Again, Nike is a household name, but it's not operating. It's not innovating. It doesn't have the sales growth that it did 5 years ago. So it can't command the same valuation that it did 5 years ago. And that's what you have to take into account when you're looking at valuation. So when it comes to Nike, not really a stock that I'm all that interested in. And if in fact I did own it, I would rate Nike as a sell. And that leads us to stock number 5, which is going to be Microsoft Corporation, stock ticker MSFT, another Mag 7 stock. And when we look at all the Mag 7 stocks over the past 2 years, them and Apple have been the 2 worst performing Mag 7 companies. Over the past 12 months, Microsoft has been the worst performing Mag 7 stock, down 10%, and is one of only 3 Mag 7 stocks in the red over the past 12 months. Microsoft currently has a market cap of $2.7 trillion. Over the past 12 months, down 10%, and they have fallen nearly 25% from their 52-week high. Not often do we talk about opportunities to buy a company like Microsoft down 25%. This is a company, and you guys know I talk about a lot. I love investing in companies with well-diversified portfolio offerings. And when we talk about Microsoft, it's talking about not only AI with ChatGPT, but we're talking about cloud, gaming, subscription, hardware, and the list goes on. With Microsoft, you also get a little bit of a dividend, near 1%, but that dividend has also been growing at a 10% clip and been growing for roughly 20 consecutive years. In terms of valuation, it looks decent, but not even close to that of Alphabet, as the company currently has a forward PE of 24.5 times, which is below their 5-year average of 29.9 times. EV to EBITDA sits at 19.4, which is also below the company's 5-year historical average of 22.9 times. The stock is definitely trading at a discount compared to its 5-year historical average, but I believe there's still plenty of pressures on a company like Microsoft. The valuation just got way ahead of itself over the past few years, so now it's starting to reset. So right now with Microsoft, especially when you have the opportunity that you have with Alphabet, I would definitely have to rate shares of Microsoft as a hold. So there we just looked at 5 companies trading at or near their 52-week lows. We went through their valuations. We talked about the pressures that they've been going through in the past few months and years from that standpoint there. So down in the comment section, you let me know which of these 5 companies that are trading at or near their 52-week lows would you most like to buy in your portfolio. And if you haven't done so, make sure you show your appreciation by simply clicking that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.